I'm Bill Lenderman. This is one of a series of monthly discussions to be held one time a month on Friday, 9 a.m. Mountain Time. The purpose of the discussions is to provide insights into concepts people may not know or don't fully understand, to correct misconceptions about important issues, and to build a community of wise and thoughtful people who know how to use money as a tool. When this portion of the discussion is finished, I'll open up for people who are able to attend live. I'll open up the discussion to those who would like to participate. Today's topic involves transfers, savings, investments, and gambling. I'd like to give you the definition of each and then give you some idea of the proper use of each. Now, we may not be able to get through all of them today. I may stop after explaining transfers because I want you to have plenty of time to ask questions or make comments, and what we don't finish today we'll do next month. Again, this first topic will be transfers. Now, a definition. Transfers are money drained away and given to someone else so that the money is lost forever. This is the fastest growing of the four categories, and I'll try to explain why, starting with taxes. The first of these transfers is taxes, and taxes are the largest single transfer. If you just take a family of four with $100,000 net taxable income, and I'm using that because it's a round figure, but with $100,000 net taxable income, they'd be in the 25% bracket. Their tax would be $16,713 for the year. That's income tax. But FICA tax is 15.3% on the whole amount. So that's another $15,300. Now just take another tax, Obamacare. If a person says, I don't want or can't afford health insurance, they're going to pay a 1% tax for each member of the family. So that's $4,000, 1% for people on $100,000. The total out-of-pocket taxes on $100,000 as a start will be $36,013 for the year. That's a substantial cut into a person's income. Of course, if you buy the insurance that's required, that will be many $1,000s more every year, and I'm not counting that. It becomes an expense to buy something you may or may not even want. Now, if you take a look at this sheet, you will see some of the very many extra taxes that we're all exposed to. It'd probably be a little shocking seeing them in one place, but take a good look at it because the income, the FICA taxes, and Obamacare are only three of the most obvious taxes. In fact, it's against the law to show unemployment taxes on an individual's pay stub. And I think the reason is very clear, because if an employee saw the amount of money being spent to protect his income, if he's fired or if the business goes out of business, if he saw how much that cost and said, I don't want to pay that, I'd rather have it in my paycheck, it's likely to make him good and mad. So it's literally against the law to tell an employee on the paycheck what that cost is. Another transfer is interest payments. People put money into tax-deferred programs as an example. And I see, and that's a thoughtful idea, and it's the best choice they've been given. But they want to save that money for retirement, but the result is any money put into an IRA, a 401k, a simple, a SEP, any of those things, is money that can't be touched until a person turns at least 59 and a half and sometimes older. I see people who are going to pay on their present schedule hundreds of thousands of dollars in interest payments that don't have to exist. Why do they exist? Because they've thrown the money into a government plan where they can't touch it. So whatever they buy during their lifetime, homes, cars, whatever it might be, they have to buy on credit. And the interest is enormous. If people did not put money into these government programs, they could pay for current things with cash using their own funds and save tens, sometimes hundreds of thousands of dollars in interest. Now you think about $100,000 in interest that we pay to somebody else. If that money were in our own pockets and grew at 5% a year for like 12, 13 years, it would double. I have not seen anybody yet who has made money in the last 14 years in these qualified plans. Wouldn't it be much better to double your money over that same period of time with no tax implications at all? You get the idea. There are also loans that people make, again involving interest. I have one couple who are becoming clients that I talked to recently. They owe $47,000, and if I remember correctly, the way they were paying it, currently paying it, with the amount they were paying towards each one of the loans, they would end up spending $250,000 over 30 years. I was able to show them how to cut that down to 6 years, and all those bills would be paid, and a couple of $100,000 worth of interest would be eliminated. It's such an important point, because the money we pay in taxes and interest payments is money gone forever and is not usable for our own families. Then another category, accounting and tax preparation. The government has made taxes so complex that people can't figure it out. So we go to an accountant and have the work done. Well, that's a cost. The accounting itself takes time and money, and then the tax preparation, even more money. There's another transfer. That's service fees and penalties. We're told mutual funds are a wonderful idea. Well, maybe they are, maybe they aren't. But there are fees involved in those. Initially is the normal, you pay a certain fee to get in, sometimes you pay a fee to get out, but always there are fees in the middle, annually. Those fees eat into the value of the accounts. There are annuities, which are very similar to mutual funds, if they are variable annuities where you have the choice of investing your money as you choose. And it's not bad, but you also have extra fees for the guarantees that annuities provide. Annuities are valuable, and it's worth the cost of the extra guarantees, but it's another drain on your returns. So annuities generally return very low results. There are brokerage fees if you're dealing with a stockbroker. Every time you buy, every time you sell, there's a fee. Of course, credit cards have fees. My wife and I experienced something a couple of years ago where she's always paid the credit cards off on a monthly basis on time. One time, a couple of years ago, she paid on time but wrote the wrong figure. I think we owed a couple of $1,000 for that month's bills, and she wrote it for like $10 less than it was supposed to be. Just a simple mistake. Well, when we got the bill the following month, there was a penalty of something like $45 on it because of a $10 mistake. I called him and I said, look, we've never had a fee. This is a convenience for us. If we have two choices. You can eliminate the fee or I'll cancel the card. They eliminated the fee. The following month, we get another $25 fee. And I called and asked, what's this? They said, well, we charge a fee for 2 months when a person doesn't pay the whole thing. So you may think you're paying 12, 14, 18, 22% interest on your credit card, but I would be willing to bet you that the fees are greater than the interest payments that they talk about. So it's so critically important, as an example, to pay credit cards off monthly and never have a balance. There are also fees for advisors. A lot of times people are too busy to figure out how they want to invest or where they should put their money and why. And there's another cost. That's money given to somebody else and not usable for investing. Another transfer payment is a good one, and I'll end with a good one. When individuals have a family where the parents and the children and the grandchildren all communicate and love each other and want to help each other, there are ways which money can be created quickly and without risk and benefit everybody in the family. That's the way wealthy people do things. They create a lot of money using a very small amount of money, and then they can pass a great amount of money tax-free without lawyers, without taxes, without all kinds of legal complications. And I would be willing to bet that most families, if the mother and father love their kids, the kids love their parents and the grandchildren, this can be done. And it's something you may want to look into, and it's something that I could share. We could do a little brainstorm, and it's very probable that in most families something like this could be possible and very, very profitable. That's the way wealthy people do it. Poor people don't know these things exist. Now, I'll be ready now to open up to questions and comments. If you have a thought you want to share, a question you would like to ask, simply unmute your phone and we'll talk.